Desktop Metal dropped their third quarter earnings report after losing another 6% on the day. Looks like they're down another 7% after hours too, which should give Desktop Metal investors cause for concern. So in this video, I wanted to take a look at some of those nasty looking headlines that have come up in the last few days, and we'll also dig into the earnings report and conference call in hopes of putting together a TreScore for Desktop Metal right now. You guys know I love this company and I'm excited about the future of it, so stick around to learn more. Oh yeah, and feel free to use the timestamps down below for your convenience. While going through the news, we'll also take a look at the growth potential, the current valuation, the management, the memeability, and the since I live in Japan, the stock market is open while I sleep and I love sleep score. And then at the end, we'll throw it up on the Tre scoreboard and compare it to our recent stock analysis videos too. So y'all know I've been following Desktop Metal as a potential disruptor in the additive manufacturing space. And while we've been seeing them gobbling up competition with acquisition after acquisition, we're being rewarded by seeing the share price basically dying in a blaze of mediocrity. So we'll take a look at why the market hates the crap out of the stock so hardcore right now too. I threw this up on Twitter last week as soon as I saw it, and it was indeed one of those news tidbits that most people would glance at and insta-sell their shares because it looks so potentially threatening. The linked article goes on to mention that there was a whistleblower complaint related to manufacturing and product compliance practices and procedures with respect to a subset of its photopolymer equipment and materials at the Michigan EnvisionTech plant. EnvisionTech was one of the largest acquisitions we saw DM make last year, granting them basically insta-kill powers in the dental and healthcare arenas of additive manufacturing. And when you're scooping up companies as rapidly as Desktop Metal is, it's pretty much impossible to thoroughly vet these new acquisitions and get to know, the company and all of its people super thoroughly as if it was your own, But the way Desktop Metal's leadership handled the inquiry was, I think, the right way to go. They hired a third party to conduct an investigation, and they also took initial actions, including implementing changes in the management of and procedures associated with manufacturing the applicable products. And that's just about all we can deduce from this, but we did see that the former CEO of EnvisionTech is now planning to resign, as well as leaving the board of Desktop Metal as well. We also know from today's conference call that the polymer portion of the business was the most hard hit by supply chain difficulties the world's been seeing, and so I wouldn't be surprised if something was going on, to cut corners or something like that. But overall, I'm happy with the way DM's management is handling the fumble, and it shows that they're trying to be above board, I think, for the long term. The next big news tidbit of recent days is DM's strategic partnership with Shapeways. While Desktop Metal is working to build the machines, supply chains, and service to provide additive manufacturing capabilities to producers, Shapeways is kind of an in-between for smaller companies who need to 3D print, but aren't interested or can't afford buying machines quite yet. Shapeways is a $331 million SPAC that seems to be growing nicely with more than 1 million existing clients and massive repeat customer revenue. Desktop Metal will be receiving $20 million from Shapeways in the coming quarters as part of the strategic partnership, though it sounds like those numbers are going to be hitting the income statement most likely sometime next year. So for those of you who are looking for an income bump on this quarter's income statements, hold your horses! Next, onto the actual earnings report, where they showed us some promising growth this quarter despite supply chain difficulties. Revenues were up 34% from last quarter and 907% from last year to a gorgeous 25.4 million buckaroonies. Non-GAAP gross margins of 27% up slightly from last quarter and an adjusted EBITDA of only negative 26 million. Seeing that margin expansion on top of the revenue growth was something I was expecting, and even though the page says these revenue figures include the acquisition's revenues, on the conference call it sounded like they were still calculating like some or all of those numbers, so it's like a little bit unclear. Next, I did want to take a quick breeze over some of the business highlights so we can get an idea of what's on the horizon before we dig into the financials a bit more. They did finally wrap up the X1 acquisition successfully. And that deal was announced earlier in the year where Desktop Metal paid about $561 million. Though that includes all of X1's cash and equivalents, along with the $57 million order backlog they've already amassed. This deal capitalizes on both companies' strong points, including their respective customer and distribution bases, and I think it should pay for itself many times over in the coming years. And even more deals going on here to further strengthen Desktop Metal's vertical integration. Meta Additive will improve printing capabilities, especially for larger pieces, by reducing shrinkage. Dude, does that say shrinkage? Isn't that like when you jump in a cold pool? And we talked about Adro in an earlier video, granting Desktop Metal access and dominance in yet another complicated and valuable space of the market, fluid power systems. Now this next slide is going to be a bit of an overload, but basically Ernst & Young Global Reports is expecting roughly 46% of companies, I think ever, like in the world, to have adopted some form of additive manufacturing in their supply chain by the end of next year, by the end of 2022. And as a result, based on a Wohlers report, they're forecasting a 25% compound annual growth rate in this entire additive manufacturing market in the next 10 years. So here it is, showing the total addressable market for their operations expected to hit $146 billion by 2030 based on other people's research. And one of Desktop Metal's long-term goals is to control double-digit market share in the additive manufacturing market. So on the back of these services listed on the right here, if they were to hit the minimum of 10% market share that they're aiming for, they could be hitting something like $14 billion in annual revenues. So going back to where we are at roughly a $100 million a year run rate, look like there's gonna be some growth going on here. Woo, doggy! And if you're unfamiliar with the way they hope to onboard clients, here's a simple illustration that expands on the age-old printer and ink business model by providing more complex varieties of materials, ever-improving machinery, and killer apps leveraging the 600 plus patents that give them access to printing with all kinds of difficult to manufacture materials. So while we're still seeing DM and this entire industry in its infancy, I gotta give them a growth potential TreScore of 9 out of 10. There's definitely risks involved when you're looking at companies this young, but while they're working hard to build out their staff and smoothly integrate their new acquisitions and partnerships, I'm pretty excited for the future of this company. They did also provide a full year outlook for 2021, where they estimated a 459% compound annual growth rate on revenues from 16 million last year to 92 plus million this year. Now these figures do exclude the X1 revenues, so we're indeed comparing to apples. Including those X1 figures I think would make the calculations a bit misleading, but could also pump the revenue figures up big time. On the right side there, they also mentioned that they're expecting in the fourth quarter alone to pull 36 to 46 million excluding X1, which will be almost half of the entire year's revenues. So if you broke the revenues down into quarters, it would look like one of those parabolic dream curves that we all love to see in our investments. Now imagine what it'll look like when they start to include the X1 figures next year too. Next, before we jump into the financials, I want to remind you that this is a recently SPACed company. They're making acquisitions left and right. They're diluting the ever-loving crap out of their stock too to pay all those bills. So these statements are not reassuring, especially if you're used to more conservative, investments. But thankfully, myopic Wall Street only looks at the now, which I think is one of the reasons this stock is trading at like $7. Additionally, because this is a new industry and no one else is doing things like DM is, there isn't really anybody else to compare valuations to in a helpful apples to apples way. On top of that, on the conference call, management reiterated the fact that the supply chain bottlenecks would continue to kind of screw with their growth for the coming quarters too. So let's take a look at the financial results and the valuation. We have this year on the left there, and boom, right off the bat, massively decreased cash and equivalents thanks to the recent shopping sprees and all kinds of other growth. I told you guys this ain't gonna look pretty. It's kind of like when your own personal balance sheet gets nuked when you buy a brand new car with cash. After a few years, the car starts to pay itself off and the overall calculation starts to pull ahead of where you would have been if you kept that cheap, crappy clunker that was costing you $3,000 a year to repair. It's kind of like that, kind of. Though we do see property and equipment growing a bit more commensurately, I'm kind of alarmed by the goodwill listed here. Goodwill can fall victim to creative accounting practices, but that's what you get, I guess, when you're just acquiring all of your competition. Intangible assets below that are things that can actually be bought and sold individually, like patents. Next, I've added the liabilities on the right side, where I don't see anything particularly alarming to take note of. They've recently tripled production capacity for their P50 machines, and part of that move is probably reflected here in the lease liability line items there, which has more than tripled since last quarter. So, young company doing a lot of growing. I don't see anything to be particularly terrified about yet. Next, we have the consolidated statement of operations, just so we can see how much growth's going on in a more granular way. 3-month periods on the left and 9-month periods on the right. And right off the bat, we see both product and service revenues falcon punching the 2020 numbers, which is promising. And sliding down when we take out the COGS, cost of goods sold, or I guess in this case, total cost of sales, we see the switch over from negative gross profits into positive on both timescales. R&D spend is picking up pace, which is good, but sales and marketing and G&A are massively outpacing previous quarters. Again, this isn't something to be worried about. It's just something that happens when companies start growing at a rapid pace. So yeah, obviously we're going to net beastly operation losses down here at the bottom because of that rapid growth in investment spending. Ultimately, all of this spending brings us down to the net losses where, after diluting shares by 63%, Desktop Metal's negative EPS has gotten significantly bigger, putting us way behind street estimates of roughly 6 to 9 cents loss per share. In the conference call, CEO Rick Fulop shared that part of the original vision has been to focus on the top 10% of the additive manufacturing industry and hopefully either acquire them or partner with them, ignoring the other 90% of undesirable companies. So yeah, big losses like this shouldn't be a surprise for the first few years of operation. And to be fair, pulling long-term consecutive losses is nothing new in tech. Amazon for like 5 years, Tesla for like 18, cough, cough. So yeah, this is definitely a riskier long-term hold, but when I consider how absolutely massive they could become in just a few short years, I'm pretty excited about the opportunity. I don't think we need to be too worried about liquidity for now, as it seems SPACs kind of get a free pass on just printing shares whenever they want to, though that will factor into shareholder return as we've already seen this year. But I think probably out of most of the stocks I hold, I feel like this is the most likely to be a relatively drama-free 10-bagger or more at current prices. Though for the short term, a 40 to 60% jump really wouldn't surprise me once the right eyes get on this stock. Though honestly, I'd be shocked if we weren't back to at least 12 or 14 bucks by next summer. The multiples are all kinds of silly right now too. We're still seeing big negative EV/EBITDA figure for both X1 and DM, and to be fair, pretty much everyone in the industry, because the market just doesn't know how to value them yet because it's all too new. Desktop Metal falls under the manufacturing category, right? Yeah, I think so, but it's also tech, right? Yeah, but it's also supply chain, right? Yeah, they're like rebuilding supply chains. So as you guys know, a lot of this TreScore thing is subjective and just for fun, but for now, I'm comfortable enough with the growth we're seeing to give DM a current valuation TreScore of 8 out of 10. For this next one, I wanted to hear what you guys think about the potential memeability for Desktop Metal. I think even though it's basically just been a one-way street to Dumpsterville for the last 6 months, I really wouldn't be surprised if some combination of Wall Street bets and hedge fund money gets more excited about this stock and we start to see it take off like crazy. We haven't seen anything like that yet though. As of a couple of weeks ago, short interest was at 10.3%, with 49% of shares being held by institutions, implying a bit of stability actually. 10% short interest is honestly surprisingly low for a company whose price chart kind of looks like Blockbusters did back in 2010, but it's not nothing either. This isn't GameStop levels of short interest, but it's definitely more than most larger tech companies have to deal with. So I give Desktop Metal a memeability score of 6 out of 10. On the management front, I'm mostly impressed and pleased with the way Fulop and his team are handling things so far, and I don't think I can fault them for anything quite yet either. But media coverage of most $2 billion companies is pretty hard to come by, so I think there's still a few question marks for me that I, hope to get clarification on in the coming quarters. I like the way they're handling the whistleblower issues I mentioned earlier, as well as the aggressive yet calculating expansion methods too. Should also mention that Fulop was chosen as the CEO from among the 7 founders of the company back in 2015, and he sits among some pretty top-notch talent, so that's worth something too. So with that, I give DM a tentative management TreScore of 7 out of 10. Desktop Metal boasts a surprisingly low beta of only 0.36, which is lower than most of any of my other holdings, I think, which means that their stock price movement is pretty disconnected from overall market movement. That's not necessarily a bad thing, as we're seeing the market relatively flat in these last couple of trading days, and we could see a pullback in the coming weeks too. So while Desktop Metal's not super stressful to own, it's also not a super easy set and forget stock after shedding nearly 50% of its value in the last 6 months either. So with that, I give DM a "since I live in Japan and the stock market is open while I sleep and I love sleep" score of 6 out of 10. So how does Desktop Metal stack up on the scoreboard? Check it out. With a TreScore of 36 out of 50, ties for second place with last week's look into Nokia for basically all of the completely opposite reasons. If you're invested in Desktop Metal, you're going to need to understand more about the recent acquisitions, so click on this video here. I love you guys and stay generous.